If history is any guide, we are certainly headed for a recession, perhaps even a depression. Today we will discuss how the stock market is crashing as central banks react. You came here for the truth, so let me unveil that for you. Now, I don't use that term, crash, lightly. This is a very serious scenario that is occurring before our very eyes in slow motion, and let's discuss some of those factors right now. As we look at this, the Shanghai Composite, this chart happens to be a day old at the time of this recording, but what I wanted to show you was that it's being supported at this 200-day moving average. The computer algorithms that they have put in place are there specifically to stop this from dropping beyond a certain point. It's a fully automated system that they have running, and here at the Money GPS, I'm actually showing you this as it progresses through. So you're consistently getting those updates as we see the fraudulent behaviors that are occurring with all of this. So you don't need to know anything about the technicals, yet I'll show you that here and show you why it all makes sense now. Look at commodities. We see them taking a massive drop since the financial crisis, and some even more recent like oil, for example. But look at this, going from everything from soybean oil all the way through copper, silver, sugar, gold, coffee, and nickel, looking at over 40% for some of these in a decline that has been hurting people all the way through. Big countries like Saudi Arabia, who are exporting their oil, are definitely hurt by this. Russia, of course, being hurt by this as well. A lot of nations that have their major export as oil are going to be hurt by this. Think about any nation who exports a particular commodity. If that commodity is under pressure, is declining, that nation as a whole is also going to be suffering. Their currency is probably going to suffer as a whole as well. So something to think about for the future. Now, in my book, I talked about what I wrote about in the bottom paragraph there. It is important to note that commodities are priced in US dollars. Due to the devaluation of dollars, all commodities will increase, at least nominally. The dollar is losing value, therefore it will require more cash to purchase the same amount of goods. So is that commodity, is that piece of gold worth any more than it was, let's say, 1,000 years ago? No, it's one piece of gold. But dollars have been devalued over that course of time. And we can see how very serious this is as we look towards all of the devaluation that is occurring, not just within the United States, but in all countries around the world. We saw actually how different currencies are measured up against each other. Look at the Canadian dollar versus the US dollar. During the financial crisis, around that time frame, we had the Canadian dollar actually being worth more by about 14 cents more than the US dollar. It didn't last long because now it has dropped down to nearly 30 cents less than the US dollar. It looks like it's continuing to decline, in fact. And what does this mean? Is your dollar necessarily any different? No, it's all in relation to something else. Let's move on to this here. Let's look at Japan and the US. The first chart is Japan's key interest rates from 1989 to 2016. And it's pretty small font, so I'll just read that to you in the yellow sticky note. Japan raised rates one time from 0% to 0.25% in August of 2000, causing term interest rates to crater. The Bank of Japan had to reverse course within 7 months and lowered back to 0.15 in February of 2001. Then you compare that to what's happening with the US at the bottom. And what we're worried about here is that, and something that I've mentioned before, if they do bring interest rates up, they may simply bring them back down again. They may not be able to withstand this. They may want to show that they can handle it, but of course they can't. So they bring the interest rates up only to have to bring it down again. Something that very well could happen in the near future. Let's keep our eyes on this. Japan's health has never recovered. Let's look at Goldman Sachs. information here. Basically, they're calculating out the what's happened in this here with the Chinese stock market, and now they're buying up stocks. I've mentioned this many times before. They are in fact admitting to buying up the stock market, and right here the national team bought 900 billion worth in June to July of 2015. Admittedly, this is what's happening, and you can see relatively large, of course that's in the Chinese currency, 900 billion, but that is still relatively a large amount being purchased for this type of market here. You know specifically that the central banks are reacting to what's happening within the stock markets, and they are buying up shares. People will deny it, and I simply do not care. You need to look at this. If central banks are buying up the shares, they're reacting to the scenario, and it is not as if they could simply utilize another method. They've given up on all of their methods, and they're buying up shares of the stock market. That's the last line of defense, when you have to literally print up money and buy up the shares. That is very, very sad. Let's look at this. The Swiss National Bank is taking advantage of the incentives that they are given, and this is right here there how they are purchasing up many different companies, primarily Apple stock. So even the Apple stock significantly declined, they're still buying up shares throughout the whole time, because all they have to do is print up money out of thin air and then buy up the shares. What does that do? Well, it supports the stock markets. The US stock markets, and it was admitted with the CME, are giving incentives to other central banks to buy up their shares at a discounted price. Must be nice. So right here they are effectively buying up shares of the markets to support them. Other markets as well as their own markets. And this is really fraudulent because it's not even real investors. The real investors are pulling out. I'll talk more about that tomorrow, in fact. I have some information to share. Look at Saudi Arabia hurting from the oil price. Look at this. Saudi Arabia is returning to the bond market with a plan to raise $27 billion by the end of the year, as the starkest sign yet of the strain in lower oil prices is putting on the finances of the world's largest oil exporter. They're hurting big time because of this, but they're not the only one. Bankers say the Kingdom's central bank has been sounding out a demand for an issuance of about $5.3 billion a month in bonds. They need people to buy up these bonds desperately, simply because they are really hurting and they're not making the income that they used to. So what do? They take their garbage debt and they put it out on the market at a percentage, and people buy it up. Why? Because a lot of those investments in the Eurozone are earning negative interest. So they don't want to buy up that debt. They'd rather buy up Saudi Arabia's debt and earn a small income from that. So what we have here is basically this continued process of central banks reacting to the markets in a drastic way. If you found this video informative, please give me a thumbs up. Truly, I do appreciate this very much. Trying to get back to all your emails. I only have a handful in there left. If you ever want to email me, it's david@themoneygps.com. It does take me a while to get back to you, but I always do reply to emails. Priority, of course, is on those looking for consultations and other individuals. Whatever you need, just email me. I'm always available to email back. Last but not least, if you found this video informative, I know you'll find my book, The Money GPS, even more informative. And you can actually flip through the book. If you go over to Amazon, they have this look inside feature, which allows you to flip through the book for yourself and see if you like it. Take care.